Welcome to Kenton Teaches. Enjoy the video.
Hello everyone. In this video, I will explain how to set up an iron condor on Robinhood. This powerful options strategy is designed to profit when a stock trades within a defined price range. It involves 4 different option contracts, all sharing the same expiration date. We will walk through each step, from understanding the components to placing the trade and managing your risk. Let's dive right in and learn how to implement this strategy effectively. An iron condor is essentially built from 2 credit spreads, a bear call spread and a bull put spread. First, you sell an out-of-the-money call option and simultaneously buy a call option with an even higher strike price. Then, you sell an out-of-the-money put option and buy a put option with an even lower strike price. The primary objective is to collect premium from the options you sell, betting that they will expire worthless. To set up an iron condor on Robinhood, first navigate to your chosen stock and select trade options. Next, pick an expiration date, typically 30 to 45 days out. You will then build your 4 legs, sell an out-of-the-money call and buy a further out-of-the-money call. Immediately after, sell an out-of-the-money put and buy a further out-of-the-money put. Robinhood allows you to place these 4 legs as a single, combined order, which is crucial for proper execution. With an iron condor, your maximum potential profit is the net credit you receive when you open the trade. Your maximum loss is limited to the width of one of your spreads, minus that initial credit. You achieve maximum profit if the stock price remains between your 2 short strike prices at expiration. Many traders choose to close their positions early, often at 50% of maximum profit, to avoid potential assignment risks as expiration approaches. Always understand your risk before trading.
Thanks for watching. Please subscribe if this video was helpful.